call this meeting to order. And first of all, thank you for coming. And as you know, we were talking about the learning curve. And I don't know where I am in the curve, so I'll let you know once I just start leveling out. But since this is a good opportunity for introductions, real quick, I just want some of the new folks that came with me, maybe just stand up, say who you are, what you do.
Sure, Ben Ellis, I'm the Chief Operations Officer, and I came over with Treasurer Thorson from Secretary of State's office.
Phil Huffman, I'm the Chief Deputy.
Jennifer Olson, Deputy Treasurer and Chief Legal Counsel.
Amanda O'Neill, General Counsel.
We're all still doing that,
Yes,
the new folks.
Michael Harry, I'm the Chief Compliance Officer and Director of Government Affairs.
And Chris put together a little packet in your, a little cheat sheet, so to speak. So for those of you who aren't as familiar with these folks, you can put a name with the face.
Awesome, thank you.
All right, item 3, I guess we need to approve the minutes. You had an opportunity
Well,
to
could I,
do that.
before, I hate to interrupt you, but I want, for the folks who don't know you, just to have an idea, I'd like to
Okay,
just give a
sure.
little bit of your background, as just so they understand that you come with a lot of experience to our office. He was elected in November of 24, so last November, through a special election. And as I believe Ben mentioned, prior to this, he was our Secretary of State for 2 terms. So 2019 through 2024, when you came here. And prior to that, he served 2 terms as the Land Commissioner. So he is no stranger to Arkansas politics. So, okay, I just wanted
No,
to.
well, yeah, you're not supposed to toot your own horn, so thank you for tooting now.
So moved. Second.
All right, I guess that means I'm in favor, so motion passes. All right, item 4. I don't have my, sorry about that. Fran, I think we
Yeah.
handed over to you for the extra invoice.
Yeah, so now for get some business out of the way. Those of you on the voting committee would have received the checks and invoices, and just wanted to see if there were any questions about any of them. Did you, oh, it's this right here.
Yeah, I saw so.
Oh, okay.
I like to.
Okay. So did you have any questions? Or need us to clarify anything?
No, you need a motion to approve as submitted.
Yes,
So moved. Second.
great.
Okay, I approve as well.
And then I had one other thing I need for approval. So with your election, we have to formally remove Larry as an authorized signatory and add you so that you're able to sign on the administrative accounts. So I need a motion to approve that.
So moved. Second.
Thank you.
Okay, we're moving right along. Now you're ready for the.
Yeah, I'll move into the director's report. So Chris and I, since it's been a while since our last meeting, so I'm not going to go into every single thing that, we've been doing since October. But some of the high points, from a media standpoint, we have been on a lifestyle show on Channel 4 a few times. We were on in December promoting the UGIF plan, and then we were on again last week talking about the tax benefits for the 529 plan. So that was nice to get that exposure out there. There was an article that appeared in the AY magazine, which for those of you who aren't from here, it kind of skews a little bit older reader. And it was just a general information article about the 529 plan. Then in February, we had a brief op-ed that ran in Talk Business and Politics. It was wording that we worked on with the ad agency, just promoting, the tax benefits. I mean, that's kind of been our message right now. And then this coming July, Arkansas Money in Politics will be doing a feature story. And will, it will be an opportunity for Treasurer Thurston to kind of get his comments and his goals out, but then also, flood the 529 plan. So that will be more of a feature story coming out. Then in terms of outreach, Chris attended the Society of Human Resource Managers meeting, which was in October, and there were like 400 or 500 people at that, and you've had some follow-ups since that meeting. We've really cultivated a good relationship with ArcBest, the transportation company based in Fort Smith. Chris attended, we were invited to come, and he attended their family kind of benefits fair. They do it more on like a Saturday morning. So he met a lot of people at that. And then he and I both went back in November and presented to kind of their executive staff. So they understood about 529 and how it could be incorporated as part of their benefits package. And that went well. And through that, it ended up kind of launching a whole other relationship for the ABLE plan. So it's just been very serendipitous. And then last, in April, I'll be appearing on a panel discussion for an event called Girls of Promise. It's I don't know if you're familiar with it or not, but it's the Women's Foundation of Arkansas, where they connect 8th grade girls who are in the STEAM, the science, tech,
Engineering,
arts and math. So in they are doing a panel discussion on scholarships and 529 and, how to look for a college. So it just kind of dovetails. So those are that will be talking to the parents and the guardians, the people we won't be talking to the kids. We'll be talking to the people who have brought their children. So that'll be good. Now I'm going to turn it over to Chris. We have a couple of legislative updates with this being session time.
So busy season up on Capitol Hill, obviously, and here stateside. So in DC right now, the biggest 529 related bill that's got the most momentum is the Freedom to Invest in Tomorrow's Workforce Act. Sounds familiar because I've reported on it over the previous 3 meetings, but this is the new version for the 119th Congress. And this one is really honed in on expanding 529 qualified expenses to capture credentials of value and professional licenses. So everything
Game changer.
from real estate license to CDL drivers. There's also a bunch of tech certifications and medical field certifications that would fall in that as well. Unfortunately enough, Mr. Harry, the treasurer, and Kenneth, they were in DC last week meeting with some of our delegation to discuss the Freedom to Invest bill. So either of you guys have insights you wanted to share?
Yeah, we had the pleasure of meeting with Congressman Hill and Westerman as well. They were both supportive. It was good, productive meetings with both of them
Awesome.
on that. So, yeah.
Who's going to own the list for acceptable activities, like as far as programs and things like that?
I'd have to go back. I believe some portions of the bill reference WIOA, the Workforce Innovation and Opportunities
Right,
Act.
you got ETPL list, you got a veterans list, you have our list.
Yeah, I believe,
Lack of standardization, standardization in this arena is awful. I mean, we've been waiting for the Fed to come along with short-term Pell, which is federal financial aid for short-term training programs, and they just haven't. It's not there yet.
yeah,
But even internally in higher ed, we struggle with which one counts, which ones don't. Is the length of is the length of the program? Is it what's a short-term license? Because not all the credentials are,
yeah.
Uniform.
or equal. I mean, some of them are very, very, can be short and have a high return, and others not so much.
Yeah, I was going to bring a printout of the bill and kind of go more in depth. I'd have to circle back and see exactly which list, it references.
Well, when you do that, we're going to be doing work on a 9-degree formula for higher ed post-session once access gets signed.
Okay.
So that's some work that we can do together and we'd be glad to help with.
Yeah.
So
I was going to say, I believe portions of the bill does, reference it, leave it to the states. you know. But speaking of, stateside, there's a few different 529 bills that we're running in the legislature right now. Three ones that have the highest impact is House Bill 1085. This is just Arkansas adopting the federal change a couple of years back, allowing unused funds in the 529 to be rolled over into a Roth IRA. Because of the way our establishing legislation is written, whenever there's a federal change, we have to wait until the next regular session, depending on the schedule, to adopt that. And Senate Bill 422, Fran's gonna touch on an initiative that we've been working on later on that this would impact. This would allow nonprofits to obtain from different agencies, school districts in particular, social security numbers, date of birth, that type of information for the students of that district for the sole purpose of opening up a 529. And I'll let Fran
Yeah, we'll talk about
discuss it
that.
later, but it'll allow an opt-out feature of a lot of CDA and CSA initiatives as opposed to an opt-in, which historically doesn't have as good a participation rates. And House Bill 1352 would prohibit certain Chinese-related investments in a state-sponsored 529 plan. And we're currently working with Kim and John on discussing what impact that would have. So,
And Amanda.
yes, and Amanda, sorry. So, did anybody have any questions? Discussion?
Has teacher retirement taken a stand on this bill or?
1352.
Mhm.
We are neutral. We negotiated some changes. We're trying around our private equity side, and that's been carved out.
Okay.
There may be one additional amendment coming. Not a major one, it's just correcting a typo, but as of now, we are good with it. We will have to transition some of our investments, but that shouldn't be an issue for us.
Okay. And we have, just so you all know, we've alerted, like he said, John and Kim and Vanguard, Amanda, to let them know that this is something that may be coming. So just to be able to make the change. Now, it does not have an emergency clause on it, does
I
it?
don't believe it is.
So meaning it wouldn't go into effect until, well, would it be-
year?
Because an emergency clause,
It would go into effect probably in August, but it allows for a year for divestment.
okay, so it wouldn't be 6 months or anything like that. Okay.
The biggest thing that I would draw your attention to, just in case you haven't really looked at the financial statements for anything that you have invested in the fixed income sphere and stuff that represents the ag. The ag benchmark has like 0.0003% and of it invested in like 2 Chinese companies. Now they're US issued bonds, but they're from Chinese companies. But to be forced to divest from the ag would be, a pretty big change for such a small level of investment. So again, most portfolios do have investment in the ag. That's why I mentioned.
Right. And I'll say the typo that I'm hoping they'll correct, I think it would carve that out because it would allow an exemption for an investment product in which less than 1% is.
Yeah. But, John, and we took a look at it as well, and right now the exemption says less than 1% and going to cost more than 1% of the total investment over 5 years, which is a lot of money.
Right, and the change, which my understanding is they will make on the Senate side, is changing that and or.
Oh,
Okay.
okay.
So,
So that would make things a lot easier.
Everything.
I would encourage you to maybe encourage the sponsors to along those lines, but that's,
Okay.
my understanding is they intend to make that change on the Senate side.
Okay.
Same concern has been, this kind of legislation has been around for previous session too, so the 23 session about for higher ed funds and things, so yeah. And not just funds, but also research activities and engaging with those and intellectual property, so And that's the crux of the issue. There's a piece of a piece in a fund that doesn't make up much.
Right.
And who sets the go, no-go list? The guy gets to set the legislation and following up and cleaning that up, because the end user, even the institution, really doesn't have a lot of control over that.
Right.
Yeah.
Right.
Good.
Easy to mess it up and on that. Right.
That's good to know.
Right. That's normal legislation.
Yeah.
Typical. All right, we ready for, Kimberly, I think, everybody good? How are you?
Thank you. I think I've introduced myself to everyone, but my name's Kim Shockley and I work for Census and we manage the 529 plans as well as the ABLE plans for the state of Arkansas. My presentation focuses on the direct plan, and then John and Amanda will both speak more specifically to the investments and how they've been doing. As of December 31st, 2024, the Brighter Future Direct Plan had just over $656,200,000 in it. As you can see, if you go from January of 2024 through December, we've seen a pretty healthy increase, about $30 million. And this plan has been being very stable. I think that's what how I could best refer to it. Stably growing, no huge ups and downs, which I think is exactly what you want for people saving for their children's future education. In 2024, we've received contributions of $65,600,000 into the plan. As is true with most of our 529 plans, in January and December, you see a lot of contributions through gifting, either gifts based on the holidays from friends and loved ones, or sometimes people try to reach their maximum contributions for the year, either making sure they get there in December or just maxing out the account in January. If you go to the next page, it's our withdrawals. This is a college savings account, so as one would expect, you're seeing most of your withdrawals at the beginning of a semester. And in 2024, we had $55,200,000 in withdrawals. 529 plans are meant to be used. So we want to see these withdrawals. We want to see people using them for either higher education, K through 12 education, some sort of apprenticeship work after college. So this is why you're seeing most of our withdrawals, like I said, at semesters. The net flows are positive for 2024. There were $9.3 million in net flows. So that's anything that went into or out of the direct account for Brighter Futures. I think this is the best slide because regardless of withdrawals people are making for school, regardless of market conditions, we're seeing the actual number of funded accounts grow pretty consistently. I think if you were to take this and do it annualized, you'd kind of see a really gradual incline in the number of people who are choosing to save in the Brighter Future Direct Plan. And at the end of December, we had 36,322 funded accounts.
I think December, wasn't it the highest number of new accounts we'd ever had? It was like a 220 or something.
At least since 2018.
Yeah. No, so I think that's great. I think some states are not seeing that sort of growth. Arkansas is stably growing over time with more and more family saving. And I think if you look at this next slide, you'll see it's a lot of Arkansas families.
I don't know.
So of the 36,000 accounts listed, close to 32,000 of them are Arkansas residents. So people in the state of Arkansas are saving typically on their own in this plan. It might be attached to an advisor. Sometimes the direct plan is just so much cheaper and easier. They go into the direct, but people are able to simply create the account and start saving for their children's future.
So Kim, where's the non-Arkansas group represented? I see the color out to the right, but I don't see it in the bar
If you
chart.
look up on top, the 4,502 for December 2024. I think what happened was the color, they just,
The highlight over.
the highlight.
The highlight,
they put the whole thing.
okay,
Yeah.
okay,
Under that yellow, it's green.
okay. Thank you for it.
And the average funded account size is just over $18,000. That, even though, you see a little ups and downs in that throughout the course of the year, it's still, if you go from January to December, it's trending upwards, which I think is good. And at the end of December is exactly when you're expecting to see those account sizes go down when people pay their tuition.
Is there any account for like the inverse peaks and valleys between like 21 and 24? It's almost like a mirror image on the 18,000 line.
I didn't see that in
It's an anomaly.
particular. If it is an anomaly, it was also right after COVID. Life was weird, right around that time, but I can take a look, and get back to you on that, Ken.
Generally, 2021 was seen as one of the biggest sort of asset growth years in just the financial markets in general. I think it was just a huge rebound, as you said, with COVID. And so that's why you see a lot of similarities in the structure of kind of assets between 21 and 24, because 24 was also a big asset growth year as well. So that's why you see kind of 22 and 23, weirdly enough, they were also kind of mirror images of themselves, in that those 2 years were actually bad market years as well. So
I think it's just like monthly inverse market fluctuations because they start and finish at almost the exact same place.
Right.
It is kind of strange that how it worked out that way, but both like really strong market growth years essentially.
I would say a difference in 2021 was less people were choosing to go to campuses,
Right.
Go to school. They might have been spending a little less on their schooling, even if they weren't continuing to learn virtually.
We also had a little bit of stimulus money in 21.
Mhm.
And like John said, the market
Right.
earnings were great.
But if that was the case, it seems like the account in 2021, the account size would have gone up because we've been spending less, not dipping down. Like in September, and,
Well,
I know it's
some of these are unqualified withdrawals too, right?
Yes,
So
anything that
maybe
happens in the
people
account is being
were,
counted.
if, they were without work or something, maybe they were dipping into it and taking an unqualified withdrawal.
My last slide here for direct is just the average account balance by any age. We're really looking to grow the 0 to 5 category. Chris and Fran and Lindsay with the census are working with your marketing team to really try to get right in front of this 0 to 5 age group, so people start saving as early as possible. And then I think it's pretty typical, you're seeing it grow until kids start school or leave high school. Even though this is a plan that now can be used for K through 12, it still is primarily used for college savings. And then 19 plus definitely does encompass a very large population. But you are seeing the balances go down at that point because people are starting to use the funds to pay for school. And I do wonder how, once your legislation changes, some are already, but rolling that money to the IRA, if you finish school and you still had money left, or made the choice not to go on to higher education.
It's going to take a very specialized kind of detailed report to see the impact of that, because with all the provisions of that Roth IRA,
Yeah,
the account's got to be X amount of years old.
Yeah.
You can only roll over whatever the annual contribution limit is into the Roth that year.
Mhm.
It's
Yeah, it is very
you have to be
specific
looking
in how you can do
exactly
it.
for that, I think, to see it reflected.
How about child savings account legislation also is going to help
Mhm.
with what Kim was just talking about, trying to get the younger kids to open accounts, right? The parents of younger kids to open accounts. That's what it's all about, getting those people started. Once the parents have a goal of savings, and once the child knows that there's a goal of savings and eventually going to post-secondary education, then that changes family behavior as well.
Absolutely.
Slide 11, it's just a little bit of information on the advisor plan. As you can see, there's less than half the number of accounts, but they have $775 million to the direct plan 656. So these are people who are saving with an advisor. They have more discretional income that they can put into these accounts. Also, when you look at the average account balance, the direct plan has a little over $18,000 and the advisor over $44,500. So it just shows the difference in income levels and what you're able to put away for such specific purposes. And it's why it's good we have both plans. So there's a very inexpensive, easy version of it for the 18,000 who are just choosing to put what they can away. And then the advisor plan where people are able to possibly fully fund their children's education.
Is there statutes or do we track the cost of an advisement plan versus the just direct? What those people spend on the advisement or for fees and stuff to
Yeah, you
to
do track that
in this,
information.
in this account versus what this, just the standard.
So, one of the ways that, so there's 3 share classes without getting like super in the weeds,
Yeah.
but within the advisor sold plan. So there's many ways that a client can choose to pay a financial advisor. When this plan was launched, it was launched with no fees to the advisor. So in other words, it was meant for registered investment advisors who get paid a percentage of the client's assets that they're managing.
Right.
So there's no way there was originally no way for the plan to provide that to the financial advisor. The financial advisor had to form a contract with the individual investor. And then based on the balances that they had, they would basically either get paid in a flat financial fee arrangement for planning. So it might be $100 to say, the year to do their kind of college financial planning. Or it could just be based on a percentage, like I said, which is like, half of a percentage point, or, it varies from 25 basis, exactly. So the client would contract directly with the financial advisor. In around 2017, we launched what's called like regular broker-dealer share classes, which, like, if you've ever bought a mutual fund at your financial advisors, or through your financial advisor, there might be a sales charge attached to it, right? And there's 2 different types of sales charge. Either there's a flat amount, which is charged every single year. It tends to be a little bit higher. So in this plan, it's like 60 basis points a year. Or you have an upfront fee, right, which is usually referred to as an A share class, which you pay a higher amount upfront, but then you pay a lesser amount going along. So in this plan, it's 3% upfront, and then you pay 25 basis points or a quarter of a percentage point every single year. Now, the reason why that's led to more positive growth within this plan is that most 529 plans were at that time sold through financial advisors at traditional broker dealers that sell plans with share classes, with loaded share classes, right? So an A or a flat fee. And when we launched that in 2017, we started to see explosive growth in this plan. That's what allowed, for example, the biggest broker dealer in this state for Arkansas anyway is Stephens, right? And so a ton of Stephens advisors came on board and started distributing the plan, talking up the plan. And you'll see that I have a page in here that talks about, like, particularly what's going on in the state of Arkansas, but we had multiple hundred Edward Jones advisors start to distribute this plan, right? Which really led to an acceleration of growth in this plan. But in terms of, if you neutralize the sales charges, if you will, the plan is actually pretty competitive with the direct sold plan in terms of underlying fees. What the state of Arkansas is really fortunate to have is that you have Vanguard, right, which is one of the biggest index product providers in the country. And you have the iShares suite of also index products as the underlying holdings within the 2 plans. And all of those holdings are extremely, extremely low fees, right? So the state has had access to basically the 2 leaders in that low fee indexing space in terms of asset management. And, both plans, all large index-based, really sort of non-active, if you will, basis of management within the plans, right? So from a fee perspective, super competitive.
This last slide is just about the UGift and UPromise rewards. So these are just ways, either A, you could share with friends and family how to donate to a child's 529 account. And then UPromise is a way that you can earn additional money that goes into your 529 account. With UGift, the total amount gifted over time is, for the direct plan, and this is funny how the inverse happens here, over $16 million to UGift, whereas it's about $6,400,000 for the advisor plan. The number of gifts into UGift is 32,335. The advisor is about 6,700. But once again, going back to our previous, if you're going to donate to direct, it's usually a lower amount, but still, the average gift amount of $500, I think is pretty generous. And for advisor, it's 950. You promise, like I said, that's a way of earning money that can go into your account, whether through your own, connecting a card to it or getting a card through You Promise. The direct plan has $2,500,000, give or take, and the advisor about 43,000. So I think it just shows how people save differently on how you rely on friends and family more in the direct plan. And then Arkansas Direct Plan residents who do use this You Promise rewards, it's about 2,500. So not a huge group of people using it, but over time, they have seen significant balances just based on, if you look at the 2.5 million, and then it's only about 2,600 people that have utilized it over time.
We're trying to get the word out.
Yeah. We just brought it up last week. So
Yeah. Just to supplement Kim's report, all of her figures were as of the end of December. Right quick, as of the end of February, we have almost exactly 54,000 funded accounts and 1.46 billion in assets under management between both the direct and the advisor. So
Can you repeat that?
continue to 1.46 billion.
So glad you just said,
54,000 funded.
so glad you said between the direct and advisor, because I'm like,
Well, that's a lot of
that can't be right.
Yeah.
I look.
Cumulative, you got that up to 2 billion.
Any questions? I'm sorry. Before, many of which may be answered by John in a minute.
Yeah. All right, thank you. John?
Thank you, Treasurer. So John Park, I'm the head of college savings for BlackRock. I've been involved with the state of Arkansas plan for at least 10 years. The Treasurer was asking me about that. So I've seen the growth. I've seen when maybe prior to us coming on board, when it was the iShares 529 plan as a branding, from a branding perspective, the structure was a little bit different. The state incentives were a little bit different. So what's been happening in the state is that there's a more friendly savings environment because of legislation that was passed. I think it was probably around that same time, 6 or 7 years ago, where they increased the tax incentive for people saving in an Arkansas-based 529 plan, and also broadened it out for saving in any 529 plan, right? So that happened around the same time that we launched these broker-dealer share classes that I was referring to. So we have seen, pretty amazing growth in the plan. The plan is distributed at most of the large broker-dealers in the country. So pretty much everybody that's doing business within the state from a financial advisor perspective, those folks are distributing the plan and talking about it. So that's been a tremendous help. And to just real high level talk about an overview of the plan investment lineup, as I mentioned, all the underlying holdings within the plan are broad-based, well-known index-based ETFs, right? So there's no active management within the plan. It's all based on, the index replicating the index constituency in terms of an investment perspective. And it's all essentially passively managed in an ETF structure. We have 3 types of investments within the plan. We have these year of enrollment portfolios, right, which move along the quote unquote glide path that start more equity heavy when the child is young. And as the child approaches college age, become more conservative and become more fixed income based, right? So the risk is kind of lowering as time goes by, and you have more investment in the equity markets in the early years so that you can have more appreciation. There's that type of portfolio. There's a fixed allocation portfolio, which just basically allows you to pick conservative, moderate, aggressive if you just want to be positioned that way. And then for financial advisors that are advising their clients, they can construct their own asset allocation and choose single investments to create essentially their own mix, right? So those are the 3 types of investments within the plan. Again, all index-based products. If we flip to slide 9, you can see some of the growth that I talked about. The slide starts in 2017 where the plan had roughly $400 million. And through February of this year anyway, we're pushing $800 billion. So hopefully this year we will get over that hump if the markets decide to cooperate. But we've had pretty significant growth, double-digit growth every single year, with the exception of 2022 when we had a housing market, as you may recall. But we've had pretty explosive growth in the plan, as I mentioned, from 2017 to 2024. That highlighted bar there shows that we've had, over 90% cumulative growth in the plans versus the 529 industry in general, which has only had 70% growth, right? So the whole industry is benefiting from the fact that the markets are increasing, but luckily we've had superior growth to the rest of the 529 industry. And as you saw, we have an average account size within this plan of $44.5 thousand, which is pretty incredible. It's actually the third largest average account size among all advisor sold plans in the country.
The report place last time.
Yeah, the last time I looked at it, it's large. So, and a lot of that has to do with the fact that these registered investment advisors that I was talking about really like iShares index investing, and so they're attracted to this plan, right? So that's why the average account size is so large, even though the plan on a relative basis, you have American Funds that has a $100 billion plan. This plan has $800 million in it, but this is, the third largest average account size. So we've had a lot of success attracting bigger financial advisors with bigger clients. And we'll talk a little bit directly about what's happening in Arkansas on the next slide. So we've had, pretty explosive growth within the Arkansas plan as well. So these numbers are through December 31st. So in terms of assets, we had 14% growth last year for the calendar year of 2024. We had a 7% increase in firms selling it within the state. So we have 64 firms. And as I said, we have 207 Edward Jones advisors alone selling the plan. We have 28 advisors from Stephens, LPL, another large national firm, 50 advisors within the state, Raymond James, 49. So, the advisors in the state are talking about it. I remember back in 2017 having conversations with, the folks in this room at the time, and they were always bringing back feedback saying that my financial advisor wants to sell this plan and talk about this plan, but it wasn't set up for that, right? So we changed that then, and we've seen pretty amazing growth. So the average account size, 20,000 approximately. That's 8% up from the previous year end. A little bit more than the direct account average account size, but the bottom line is that we're growing the number of accounts, we're growing the number of financial advisors selling the plan, we're growing the average account size. So overall, it's been very successful, particularly in the state, but the plan has continued to grow. I've had conversations with our partners at Ascensus over the years, and they've been really happy because, as I said, relative to all the other 529 plans out there, this plan has been growing, right? So we're at 800 million right now, almost double where we were in 2017, and we hope to get this to $1 billion, get over that hurdle, which would be amazing. And we're really excited about our involvement in this plan, and so I'll just stop there and see if anybody has any questions before I just touch on some brief market update comments, which I'm sure Amanda will get into in more depth.
John, are the 64 firms, 7% increase in the 481 financial advisors, that's a duplicate count, right? Financial advisors are a subset of the firms or no?
Correct.
Okay.
Yeah. So those financial advisors are part of those 64. Yeah, that's correct. Yeah. So as far as the commentary is concerned, I think, you guys are all involved in government, so you're seeing a little bit of political volatility that's happening. I think that everybody from a financial markets perspective, they're in a wait and see mode, right? So this is definitely, sort of the current administration's opening gambit anyway in terms of policy, right? And how they're going to approach it for the rest of his term. And our approach just in general is maybe not be as concerned by some of the headlines and be more concerned by some of the results, right? So in terms of the overall state of the economy, I think it's still in pretty good shape. How all of this uncertainty in the overall economic and business environment and legislative environment flows through into the real economy, we're all kind of waiting to see how that happens. Some of the things to possibly keep an eye on, right, are in terms of the labor force. How will this impact, the overall labor force that American companies have access to? And by that, I mean some of the things that you might have heard, right? When it comes to agriculture, is this going to have an effect on those that maybe are involved in, picking our fruit in the fields and processing our fruit and all of that sort of stuff? And what does that do to prices overall, right? I think that everybody's been really concerned about, overall price dynamics in terms of inflation, but the last inflation numbers that just came out last week were a little bit softer than people had expected, right? People were anticipating a little bit higher inflation. So, where this all plays out, I think we're going to have to wait 3 to 6 months to see where the tariffs all play out in terms of, input costs, in terms of metals and aluminum and all that kind of stuff that, that flows all throughout the economy, right? And, where all of this geopolitical stuff kind of plays out, I think that remains to be seen as well in terms of other input costs like oil and whatnot, right? So I think that, the biggest things that we're paying attention to right now are labor. We're paying attention to rates, obviously, and what the Fed does. And I think the Fed is also trying to see how all of this stuff plays out as well in terms of price action. So the good news is that overall, from a employment perspective, things are still in pretty good shape overall. From a company earnings perspective, things are in pretty good shape. But the concern is that decreased kind of midterm to long-term certainty leads to a drop in overall investment, right? If you're a company and you're not sure about, the operating environment going out a year from now, or how much your input costs are, and you have a choice of whether or not to hire 5 people today or hire 5 people in 6 months when you have a better idea of what's happening, right? A lot of companies are going to wait. And that the same thing is playing out in terms of capital expenditure, right? If you're thinking about building a factory, say you're an auto company, right, and you're building a factory or investing in a factory near the Canadian border, and you're not sure how these tariffs are going to play out, well, you're just going to wait a little bit, right? And so you're starting to see that a little bit. Not enough to be a major concern, but as we all know from, the economic results over the past 20 years, you just don't know what's going to happen until it happens, right? And all of a sudden, something big blows up, and these quote unquote black swan events occur where you have everybody being concerned at the same time, and they stop investing or they stop consuming, right, and buying automobiles and other things that they might have a choice on, either buying today or waiting 6 months or waiting a year, right? And those are the things that collectively make the economy go and grow, right? So if the velocity of the economy kind of just begins to slow down, that's where we would get worried. And you're starting to see the front end of that, right? The stock market price at the end of the day is just a leading indicator of what people will think will happen to company earnings in the future, right? So that's where we are right now. Again, Amanda, I'm sure is going to express it much more eloquently than I will, but that's it for me.
Amanda, it's all yours.
Hi, well, hello everyone, and it's nice to meet you. Amanda White, I'm from Vanguard. So we are the investment manager for the Direct Plan. I looked back, we've been working with you all since 2005, so we just hit up on 20 years.
Wow.
So I will share my screen here. Let me know when you see it. And I do want to take a similar approach to John, just seeing that there are some newer folks in the room, just to kind of get you familiar with the investments within the plan. Happy to talk about any changes we've done recently, some major milestones within the plan, and then we can get into the performance as well as the markets. So just kind of broadly speaking, there are 3 types of investments that you all have within your Direct Plan. There are the target enrollment portfolios, which kind of similar to the year of enrollment portfolios. That's your set it and forget it. We also have what you all call custom portfolios. So there's 6 individual portfolios that are static in nature. Those are the 2 that Vanguard manage for you all. And then there's also an FDIC insured that's separate from what we manage. So those are the 3 types of options within the plan. And John had mentioned So the Vanguard options that you all have, they are made up of broad-based Vanguard index mutual funds, all low cost. And one of the biggest changes that we've seen within the last couple years is really moving to the target enrollment portfolios. So that was a pretty big endeavor. I think Fred and Chris, you were both on board at this time in 2022. We moved from the age-based portfolios to a more progressive glide path, which is these target enrollment portfolios. So that's kind of high level, just the lay of the land of the investments as a whole that you all have. What I'll do is, I know we are a little bit short on time, so I was going to skip the trends section that I have in here and really go right into the markets. And you'll hear from what I'm saying, a lot of what John has already touched on. But let me just move back. And if you're following in your packet in front of you, this is slide 6. So just showing what we've seen the markets over the last year. And this is actually as of January, but I will definitely give some comments of more recent headlines. So, as of end of January, we really had a strong year in 2024. So the markets were up all last year, as well as through January of this year. We saw double-digit returns, specifically within the U.S. equity markets, largely led by large cap tech stocks. We also had positive, albeit somewhat more modest returns for international equities. And the bond markets were also positive for the year through January. So, and as John had alluded to, so since January, we've seen some increased volatility in the markets. And a lot of that is largely due to just uncertainty around global policy. So the markets, they do not like uncertainty, and they let you know it. And then as well, kind of more recently, just kind of thoughts on the potential for a recession here in the U.S. So with this backdrop, domestic equity markets are actually negative for the year, down about 4%. International equity, I guess one bright spot is positive, up a little bit over 7%. International bonds slightly negative, and U.S. bonds up about 2%. So some of the biggest headlines that we've seen this year that are really impacting the markets, and then, that will follow through into the Arkansas portfolios. During the fourth quarter of last year, so we saw major U.S. stock indices reach new highs during the fourth quarter. Although we did see a volatile December and a volatile start to this year, really has put the U.S. equity market into what we're considering correction territory. So down more than 4% or down more than 10% since its most recent highs. Also another, headline that we're watching and that impacted the markets is really the Fed. So last year they started decreasing rates. I think it was in September, and it was 100 basis points that they cut rates last year. So their first meeting of 2025, which was in January, they're taking a more of wait and see approach right now. So they're much more cautious, and they did pause their rate cuts. The Fed is actually also meeting this week. What we're seeing kind of within the markets and internally, we are not expecting them to make any moves at this meeting this week, and will likely keep rates where they are. And then also just, seeing this is the first meeting of 2025, just wanted to share two things that we're watching closely. A lot of it is in line with what John and, John had mentioned. So, I did mention the Fed. So we'll keep watching what they're doing. The market does tend to react to what, kind of expectations of what they're going to do. As of the end of as of the end of February, so Vanguard's projecting 2 more rate cuts, likely in the second half of this year. Although we are continuing to watch that because a lot of stuff that's unfolding within the markets could impact that. And then we are also watching, the impact or the potential impact of tariffs. So we're watching this closely. It has the potential to increase prices, or increase inflation, as well as decrease growth. And, again, to what John had mentioned, a lot of unknowns. So we're really taking a wait and see approach at this point, but likely what this will mean, at least for the foreseeable future, is just an increase in volatility in the markets. any questions on the markets as a whole? I will say, given our baseline view, and I can just bring this up here just to say kind of what we're looking at for 2025, or what we projected for 2025 as of the end of last year. We're not making any wholesale changes to our projections, but there are the potential for some changes based on some of the things I had mentioned. In particular, GDP growth 2.1% is what we were projecting for the U.S. We could see that be a little bit more modest based on any impacts from tariffs that we're seeing. Inflation, this is the potential to increase a little bit as a result. And then also, I'd mentioned we're watching to see what the Fed's doing. Any increase in inflation will likely cause them to pause any rate cuts for the foreseeable future. So just a couple of things that we're watching closely here internally. And again, will has the opportunity to really impact what the markets are doing, and then also what the Arkansas portfolios are doing. So I'll pause there. Any questions? I just want to touch briefly on the performance, which I think kind of will kind of help you understand how these portfolios are kind of what their mix is, so you can see how how the performance has been on them and what to expect going forward. So if you're following along in your packet, I'm just going to move back to slide 31. And just given the backdrop of what we've seen in the markets over the last year, you'll see that the portfolios, given that they are the broad-based index portfolios, will mirror what we've seen in the market. So those portfolios that have more of an equity exposure, so a higher equity exposure, we're talking these more longer dated target enrollment portfolios, as well as the aggressive growth portfolio and the growth portfolio. They've seen double-digit returns for the 1 year, again through January. And then also 1 to 3 month returns positive as well for all the portfolios. So as you can think, for February, again, we've seen market volatility. We've seen negative returns here in the U.S. that will impact the portfolios. So those same portfolios that are more heavy on the equity side, we will start to see more of a negative performance as a result of that. The one thing I will mention is, international equities have actually done pretty well. So these portfolios, not just domestic, they have about a 60%, U.S. exposure, 40% non-U.S. exposure. So that really kind of helps to soften those negative returns within these portfolios. So I will pause there. Again, I know we are a little tight on time, so I don't want to take too much, but happy to answer any questions.
Thank you, Amanda.
I have a question, because we have so many experts in the room. What is the certainty and the known that the markets and the Fed, you think, are looking for? Because we know, like you mentioned, I don't know if when we were over here, rather than looking at the headlines, just maybe looking at the real data, do you think that's going to be made? Is that part of the adjustment that markets and the Fed look at, like, okay, everybody knows Trump, everybody knows, he may do something, he may not. And then is that what the markets and everybody kind of finally realized, to kind of come back into a new normal, I guess?
Yeah, I mean, I would say, as a reminder, the Fed has two mandates, right? They have a mandate for inflation, keeping that down to the level that they're trying to keep it to, which is 2 and change, essentially, and also trying to guarantee full employment, right? So that's their dual mandate. And on the employment side, I think that one is a little bit easier to keep an eye on, because all these things that the current administration are doing, especially as it relates to kind of cutting all these federal workers, right? That's going to have a direct impact on unemployment. Now, one of the uncertainties there is just how many of those employees get picked up by either states or the private sector, right? So we heard after the kind of bounce back from COVID that a lot of companies had trouble hiring skilled workers, right? So do all of those federal employees, the 100,000 plus, shift to the private side of the ledger and get picked up because there was a, skills and labor shortage over there? That remains to be seen, right? And also, just in general, if you have just a decrease in consumption because people are either just kind of more concerned about the direction that the economy is going in, and or they lost their jobs because the companies that they work for are concerned because, here's this secondary effect that came out in the past week, which is that all the cuts to, university research, et cetera, right, has led to hundreds or thousands of employees being cut from the large kind of research universities around the country, right? So you had, I think it was John Hopkins that, announced that they had to cut 2,000 workers or something like that. So not all of those are in the United States. A lot of those are because of USAID, right? So it was foreign programs where they had to cut employment. But all of that, to answer your question, I think at the end of the day, all of this stuff does kind of trickle down to how many people are employed. So if you have unemployment going up, then that's kind of a distress signal to the Fed, right? And that's where, so Amanda mentioned that, Vanguard is thinking that there's going to be 2 quarter-point cuts this year by the Fed. But I've now seen that with more signs of distress, right? In the last week, some firms are saying that there's going to be 4 cuts, right? So when the Fed cuts, in some ways that's good, in some ways that's bad. If they make a cut where other people aren't expecting that cut to occur, then a lot of people take that as a major distress signal, in the economy where they see something bad that's happening and they want to get ahead of it, right? So while it's good in general that it stimulates the economy, it could also be bad from a perception perspective. So unemployment is one of the things that everybody will be looking at. And then just in general, when it comes to consumer confidence and the purchasing that people are making, right, that has a real impact on the economy because it really goes up and down the chain from the small business all the way up to the major corporation when people cut back on spending. And you're gonna start to see stats on that, right? We've already seen some consumer confidence numbers that are distressing in that people have a much more negative view in the past, month or two in terms of what their personal finances are going to look like in the next 6 months, right? And so that has to play through as well. And I think that those 2 things will lead to a lot of companies deciding whether or not they're going to invest and spend in the short to midterm. So I think that that's what everybody's trying to see. Like a lot of the stuff that's happening, it's really happening at a headline perspective and a messaging perspective. But where it becomes a concern is that, we've already seen that immigration net from a legal, seasonal, and illegal perspective, all those numbers are down, right, across the board, because the messaging that this current administration is doing is that, and we saw this in the first Trump administration as well, is that they're creating an environment that maybe is not as friendly toward immigrants. I think that, if you had to characterize it as more friendly or less friendly, I think it's, it's definitely less friendly. And that has like a chilling effect overall on sort of all types of migration. And that is something that from a corporate perspective is really, really concerning, right? So again, I think that you're going to see more as time goes by, but I think that's what everybody's paying attention to right now. Because at the end of the day, the American economy is driven by the American consumer, right? And how much they buy and how much they purchase and their confidence at the end of the day. So either this is going to be like, as the current Treasury Secretary has said, this is just like coming off an addiction, or it's a short-term, adjustment, or all that kind of stuff. And that's what remains to be seen, whether it's a short-term thing or becomes a more prolonged thing.
John, please.
Yes, this will not be quite as exciting as the last 2 reports. This is a report
You don't
on
want excitement in your.
the admin accounts. just for the new folks, the committee receives a percentage of the fair market value of the Vanguard funds and the iShares fund on a monthly basis. Those go into the Southern Bancorp checking account, and those funds are used to pay primarily marketing expenses, but also some professional fees. This is the budget report for the 8 months ended February the 28th. On the income side, we were expecting for the year to receive 691,000. It's tracking now to be about 823,000. So I think the income will be up from what we budgeted.
Just a quick note, I always try to project that income on a very conservative level, so.
Yeah. Well, yeah, but it's based, primarily on how the market does. So, yeah. And the expenses we had budgeted for those to be 604,000. Looks like they might come in around 530,000. So that'll be a little bit under budget. So overall, the income should exceed the expenses by the time we get to June the 30th. We also have an admin account at First Security Bank. That's an interest-bearing account. We had a large item, Vanguard, 107,000 deposit from Vanguard. That was for some fees that had been deferred and were paid in a lump sum. So overall, we had at the end of February $833,000 in both accounts. The Southern Bancorp account now has, as of today, has $631,000 in it. So that's the report. Yeah, could answer any questions.
You need a motion for the board. Brandon, you need a motion on that? Okay.
Was exciting.
All right. No questions? Thank you, Greg. Oh, wait, I'm sorry, we're on Greg now. Thank you, John. So now we're Greg Walker with Patty Davidson.
Unfortunately, just Greg Walker, so Patty Davidson was there.
Do you want to come to the table?
Yeah, he's just laying more.
We can just sit there. I'll sit next to the treasurer if you don't care. Okay. How's everybody doing today? So we met a few weeks ago with the majority of you, so apologies, you have to hear it again. I will keep it very overarching for the audits, but first, I want to give you kind of a brief background of Landmark and kind of what we do and kind of our relationship with the committee. So my name is Greg Walker. I'm an audit partner here in the Little Rock office for Landmark. My first full day was September 6th, 2008. And my first job was to work on the gifts plan time. So it was our first 529 plan that we did in the Little Rock office. And Patty Davidson and Randy Milligan were the partners in charge of that. So I'm gonna give them all the credit. So through John Pease, he helped us get it. And since then, we perform audits over 529 ABLE plans and auto IRA plans for 23 states. Our team, me and Patty, we co-direct the government savings teams in our office. We have anywhere between 12 and 15 people at any time working on the audits for the 529 ABLE and auto IRA plans. So we do this the majority of the time, and we're very blessed. And we've kind of been able to grow our firm along with it and see the plans grow at the same time. When we first started, we had 30-something people, and now we're at 200 and almost 40. So we appreciate being able to work with the committee year after year. So just want to say that. So
It's been a tremendous growth story for Landmark in the state of, I've been super impressed because we started working with you guys, obviously, when you guys didn't even know the plan. And I've seen you grow all across the country, and we've worked on multiple state flags. So it's been an incredible, business story for us.
I agree. Their relationship with Ascensus is very widespread as well. I work with them on many accounts. Thank you. So our responsibility is we audit both the direct and the advisor plan. And so we perform these audits. We started the work around September. We finished up the draft a few months ago. We're actually going to be going to issue finals today, pending some information from Ascensus, which we got yesterday. So we're just waiting on one piece of information. So overall, they are clean opinions.
We did testing over the financial reporting process and over internal controls and on compliance, and we found no issues. So in your pack, there is a lot of information. I will not be going over the information. Numbers have been discussed between, John and Kimberly, and so we are not going to discuss that. So I will just briefly explain what is in the financial statements themselves. So I don't know if you have.
Your treasurer.
So this is everything that's in the annual report for each plan. So each one has its own set of financial statements. The first is the independent audit report. Again, this is stating that we performed the audit in accordance with standards. We found no issues and there are clean opinions. This is the only thing in the entire annual report that is landmarks. Everything else is the committees. The next section is management's discussion and analysis, which is pretty much a Cliff Notes version of the audited financial statements. It gives financial highlights, and it also gives the investment commentaries provided by BlackRock for the advisor plan and Vanguard for the direct plan. The next set is the actual financial statements themselves, your balance sheet, your income statement, or your statement of fiduciary net position and statement of changes in fiduciary net position. The only numbers I will state is that both the direct and the advisor plan increased over 10% from June 30. Fiduciary net position increased 10.3% for the direct plan and 11.4% for the advisor plan from June 30, 23 to June 30, 24. And so based on the slides that we've seen for both plans, you see the growth year after year. It's really incredible. Your next set is the notes to the financial statements, which are a bunch of pages of a bunch of words that we're required to disclose. Note one gives a breakdown of who is responsible for what the committee is responsible for, what BlackRock, what Ascensus, what Vanguard is responsible for. Note two is a summary of your significant accounting policies. When are contributions recorded? When are withdrawals recorded? How are your investments valued? Things of that nature. These are all standard language. Note three is a breakdown for the direct plan. It's a breakdown by portfolio, what underlying funds make up each portfolio. And for the advisor plan, how the structure is set up, it breaks down the overall amount per underlying fund for the plan. It also has required disclosures regarding different investment risks that are required by standards. The last and most important, which I'll get a little more into fees here in a second. The last note is fees and expenses, which we test in depth. It explains who received what percentages are charged, and who is exempt from those. The last piece of the annual report is the supplementary information. This is your financial statements broken down by each individual portfolio option by plan. So if you want a little more information, you're able to go back there and kind of see what the NAV is for each portfolio. So that in itself is the annual report. In addition to that, there is also the audit communication letter, which this is almost more important than audited financial statements themselves, because if there was an issue, then that issue would go in that audit communication letter. And one thing that I do want to point out in that letter is a section called significant risks identified. It's on page 2. And so when people read significant risks identified, then they're worried that, that there's something that's wrong with the plans themselves. And that is the furthest thing from the truth. All we're stating is that based on our history of auditing 529 plans, if there was something that was going to go wrong, in our opinion, it's going to be related to the calculation of asset-based fees, or it's going to be related to kind of a one-off transaction, which is a portfolio either opening, closing, transitioning to another one, or an underlying fund doing the same thing. So on the calculation of asset-based fees, like I said, we audit these very in depth. We recalculate each portfolio for both plans and based on the average net position in those portfolios. And then we agree it to what is on the trial balance for both of those plans. In addition to that, we confirm the amount of fees that we think the committee should have received, what you all actually did receive. And same thing for both Vanguard and Ascensus. So we did not find any issues there. Everything looked good. So, because we want to make sure everybody gets paid what they want to. So, in addition to that, there was two significant transactions for the direct plan that we tested. And this was related to the target enrollment 2020-2021 portfolio. It closed during fiscal year 24 and went into the commencement portfolio, and the target enrollment 2042-2043 portfolio was added to the plan. For the new portfolio, we made sure that the asset-based fees began to be charged on the correct date. And we also, on the closed portfolio, made sure there was no balances after that. And we made sure that that it was done in accordance with the census instructions. Very last thing is the audit communication has, I don't know, 15 different headings, and most of those are related to uncorrected or corrected misstatements, deficiencies in internal control that we found, any fraud that we noted, any significant difficulties with management, and all those are no. We did not have any issues whatsoever. Ascensus, Vanguard, BlackRock, Chris and Fran working with them. John helped us with many requests. Everybody has always been forthcoming and very responsive to our requests. And we really appreciate getting to work with all parties involved. So that's what I have for today, and I'll be happy to answer any questions anybody has.
Thank you. Questions? Very thorough, yeah, thank you. All right, I guess it's time for new business.
So just have,
What would that be?
that would be, two things. One is and I think we need a motion on this, Chris, the budget amendment.
Yes.
So it's a little bit of a chess match, but the bottom line is, last August, you all approved a $17,000 line item in our budget for scholarships and grants. And we are requesting to take 5,000 out of that, and keeping in mind that we're at the end of March, so we have not dipped into that at all, for this fiscal year, to move 5,000 out of that over to our marketing budget. The reason for the ask is that over the course of this year, every other month, we were spending $5,000 on streaming TV. And following that schedule, that wouldn't have had us advertising in December. But we ended up having a U-Gift TV spot ready ahead of time. And with it being December, we wanted to go ahead and get that on the air. So we took what was allocated for May, meaning 2 months from now, and moved that into December, which proved to be very beneficial, because we can tell that it had a direct impact on the number of new accounts that was opened. So now, just to make sure we're not dark in May, just because that's also another popular time people are, recognizing kind of the milestone of their kids growing up, getting closer to college, whatever, graduation gifts. So we want to ask for that 5,000 to be shifted over so we're not dark in May.
Make that motion.
So
Second. Okay. Thank you.
then the last thing, for new business, you all have in your packets, a one-pager that has the word grow on it. And this goes back to what Chris was talking about, the legislation that is being hopefully run this week. So a little bit of background here. A little over, or almost about a year ago, it was July, I received a call from somebody with the Arkansas Community Foundation who said that they had a donor who at the time was anonymous, who was interested in opening up 529 accounts for basically adopting a school in a low-income part of the state, and it was in Jacksonville. and opening up funding and opening 529 accounts for every single student in this elementary school. So we're talking K through 5th grade. And so those are called CDAs or CSAs, but I think ours is probably more indicative of a CDA. And that's where a particular group is identified, and then either through nonprofit or grants, people have committed, to funding accounts for these kids. And in our case, the donor wanted to utilize the 529 plan. So the donor turned out to be Tempest Realty, which those of you who are here locally may know. CEO Dan Andrews is kind of leading the charge. But then also I think Mark Savers, one of the partners, is also instrumental in getting this done. So they have their nonprofit that they formed is called GROW. And what GROW is committed to doing is, for this coming fall, they will fund $600 in every child's account. And kindergarten will get $600, and any transfer students will get $600, regardless of what grade they transfer into. Then, is that right?
Yeah.
And then for subsequent years, they will continue to deposit $300 for the life of while the child is there at the school.
End of 5th grade.
So at the end of, if they're there the whole time. They will also open and fund 529 accounts for all the teachers. And the teachers then obviously, can either use it for themselves if they're paying off student loan debt, or they will have the option to roll it over to a child or a grandchild. So the hope is that this will encourage other businesses or other nonprofits to, like maybe in other parts of the state, to mimic what they've done. It's an incredibly generous program. And it also comes with some incentives along the way. So Economics Arkansas, if you're familiar with them, they are a partner. They go into the school and they're going to teach. They're also going to hold sessions for parents. So if a parent shows up at a workshop, so to speak, or, does some kind of, program or curriculum to learn how to maybe be a better saver, the child's account will get like $100 incentive or $50 incentive. So, and they have built into their funding structure a GROW ambassador at the school. So there will be a point person there on campus to answer questions, to work to facilitate all this. So, excuse me, where the legislation comes into play is right now, in order, as you all know, to open up a 529, you have to have the child's social security or the beneficiary's social security number, date of birth, private information. And we also, just sidebar, we have the Clinton School of Public Service is doing a longevity tracking of this. So we're really, this isn't a one and done. I mean, we're going to monitor the results of this. Traditionally, as Chris mentioned, people respond better, or participation is better when everybody's automatically opted in, but given the choice to opt out. So what Senator Tucker is wanting to present is when in the future, because we're having to really jump through some hoops, to get this done with the census, because it's a little bit different kettle of fish. But going forward, so it encourages, and other companies don't have similar roadblocks, if you will, it's a legislation allowing solely for the purpose of having a CDA program, like in Jonesboro or down in the Delta. it's saying, okay, school district or nonprofit, it might be a hospital for every kid who's born in a year. It is okay legally for you to share this information and also give the parent or the guardian an opt-out option. So that way we can go ahead and that it doesn't, it's, the parent is given approval or the parent has consent, obviously, and if for whatever reason they don't want to participate, they can opt out of participating. So this is in the process right now with enrollment started in February. So they're in the process of, all the parents have been and guardians have been made aware of it. They're in the process of, getting the paperwork back because right now the parents have to provide that information. And so the people in charge of this have offered this fall. So we have another meeting in the summer, which is my last bit of new business. But in the fall, there'll be a month or two in to the school year. And so if the committee is interested in having them be present at our fall meeting to give us an update as to how that's going, they would be more than happy to come talk to us. So I'll leave that up to you all.
And we can circle back on this idea later on as well.
Yeah, just, there was a child savings account or child development account forum in Washington DC that I went to just last week. And this is something that a lot of states are taking up. So for example, Oklahoma has had a really successful program, implemented for many, many years. It's seen as one of the models for success. Virginia's looking to developing a statewide program. So is Georgia. So there's a lot of states that are looking into this, to kind of improve the generational wealth transfer and overall educational attainment and outcomes within their states. So it is something that a lot of states are looking at around the country.
Well, and the Roth legislation will play into it, so in theory, if a kindergartner this year opens up a 529 and let's, project into the future, and if for some reason they don't pursue or use it for higher education.
Or they got scholarships.
With the Roth provision, they'll be able to transfer that money or roll it over. So,
Sorry.
yeah, no.
The plans you're talking about in other states, are those all driven by philanthropic or private philanthropy, or are those state funded?
So it's a mix. So for example, like the most successful program and longest running program is the state of Maine's program. So they have actually like $700 million in the program, and that was all privately funded. So there's a man by the name of Alphon, so it's the Alphon Foundation that funded that and seeded accounts for every single child that was born in the state of Maine.
Yeah.
Right? And this is now going on almost 20 years where that money has grown to $700 million. So every child in that state can look forward to having a lump of money that's been growing now for 16, 18 years that they can put towards tuition. And if you don't know much about like the kind of internal demographics of Maine, it's very agricultural, especially north. You have some shore towns, but most of the state is either involved in growing stuff, lumber, whatever. And so you don't have a lot of post-secondary attainment there, right? So a lot of families just don't even have the idea that they might send their kids for any type of training at some point in the future. So that's all privately funded, but there are state programs. So California has a program that they just launched like a year or two ago, and that's state funded. Right. So it is a mix, and it's also a mix between statewide programs and a patchwork of local programs. Right. So this is starting off local, but you never know if it's successful. It could be something that goes across the state, and it's something that obviously is very popular because this is money that in most cases by program rules, families and kids can't touch.
That's pretty clear.
Right.
Right. So not until they reach that college age, and just having something that for a lot of families that are not as well off, that is forced to grow and compound, right? Like Einstein said, the greatest power in the universe is the power of compounding, believe it or not. And just having that money that grows and then having a sum that family that's, just kind of living month to month might not ever be able to save. That's a huge accomplishment and a big difference maker.
And on that point, John, the folks that grow, when we were meeting with them and helping them answer questions, process flow, what can happen, what can't happen. from the start, they, emphasized that we want to build this in a way that every corner of the state, if there's a nonprofit that wants to get involved, they can have a part in this.
Seems like
They
they
can
can like
adopt
a,
this.
public-private partnerships or
Absolutely.
something.
Yeah.
That's right. They'll bring in some other pieces to that, some other big plans.
Well, and I will say, being from New England, the way Alfond actually created a group with people from Treasurer's Office from all the New England states, get together quarterly, talk about your program, talk about ways to help promote and develop these programs. And I kind of see the way they're trying to do this, going in that direction, because they're really looking to see if by creating this 501c3, they can create partnerships. And without everyone else having to go through the work that they had the commitment to go through, they'd be able to still make those contributions through Grow. It's a possible thought for the future.
Secretary, I'll help you champion that.
Well, and, we even talked about, if somebody couldn't, to the scale that they're doing, adopt an entire school, you might have, different companies or different, okay, I'll take the kindergarten class, I'll take the first grade, get different people involved, kind of a consortium.
It's
So,
also a very generous amount.
Yeah, it is.
Yeah.
I mean, when you look at most other programs,
Yes.
it's not with dollar amounts like this.
yes, but they were very insistent too, and I really appreciated this on the research aspect and trying to get parents, or guardians to benefit from this beyond the financial, but to have access to financial information.
And believe it or not, the ones that have been the most successful, I see the schools listed here, they've actually made it part of like the guidance counselor engagement with families. And in those schools, they've had an over 95% uptake rate where the families, like that 95% in anything is just a huge
Yeah.
number, right? And to get that many families involved in saving is pretty incredible. And even if they can only save $5,000 at the end of this, period, which is, based on this, it's probably going to be higher than that. It's pretty incredible in terms of a life-changing, an outcome
Right.
for a lot of especially poorer families.
So are there any questions about it or?
I have one question, but I want to back up just a little bit. So we had set aside $17,000 for grants and activities in this fiscal year, but we didn't use all that, so we're moving that over to fund the ad campaign for the extra month. So did we just over budget for that categorically, and will that carry over, or, we didn't use the 17? I don't know,
Yeah.
is that a just overestimate on our part?
So, yeah, it was an overestimate on our part. We wanted to have a chunk of money set aside so that, if an organization came to us and said, we're doing an operation similar to this, but smaller, and it's, a smaller scale, no potential to grow, that would have been something that we could have considered, putting an incentive towards, a matching $50 contribution to all of the.
And I remember when we were working on that budget, we, had already had this conversation that there were
Well,
other
very preliminary.
very preliminary. So we wanted to go ahead and just build in something, but we won't be needing to use it. But yeah, it will just,
Yeah, now that additional 5,000 for the streaming TV, that's probably something that we're gonna build in
go forward.
for the plan for.
I've seen
FY
the ads on
26.
streaming.
You have?
Yeah.
What do you think?
Pretty sweet. I'm like, hey, let me check that out. Because you don't expect to see those local, ads necessarily when you're on streaming stuff. So,
Yeah, I will say that for the state of Maine, because that private donation was so successful and the program that they built was so successful, the state decided to piggyback on that and launch their own grant program, feeding into the same accounts using the same rails. So all the infrastructure was already built, but they decided to just, add additional kind of, just like this, sort of event incentive driven money to say, if you do this by, you make an additional contribution to your account, you're going to get another lump of money from the state and so on. And so it's trying to just create better savings behavior throughout the whole entire savings journey.
So would you all possibly be interested in hearing in the fall how it's going, or would you just want me to give a report? I mean,
I would. I'd be interested. Yeah.
okay. Okay, well, we'll check. Because Dan had mentioned he might come if y'all would want him to.
If I can ask, so the money that goes to the account, will it be automatically put into a particular investment, like on target funds?
It's gonna be the target enrollment, yeah.
Yeah, the most appropriate targeting enrollment.
Okay. So it's really no action required by the parent
Right.
at all. It goes in and it's just ready for that child.
Well, right now, you know, because the school district is all like, it doesn't say in the law that we're allowed to share the social security.
Right.
So right now, it's an opt-in, right? So the parents will have to provide the information necessary.
Right, but once you can get that information.
Yeah.
Yeah, and Grow is considered the owner of the account.
Yes. Which is definitely.
So I've never heard of it before in my life, before today, about, doing this at the state level, I'm about doing that. But if you look at some of the ways we use lottery scholarship funds,
Mhm.
and how those are invested and what we do there, or how we use even like tax rebates statewide, couple that with some, private philanthropy, that could really be a big deal.
So Kevin Hassett, who's the, current president's chair of the Council of Economic Advisors. I just heard him speak at another event put on by the Aspen Institute, and he was doing research at the Milken Institute to come out with a paper on these types of accounts. And his idea was that it would be a federal program where they would deposit $1,000 and let it grow in state 529 accounts. Right. So if there was, which would be incredible, right? And it was the same, all the stuff that I just told you is what he said. I'm just parroting what he said.
Well, I mean, if you take a federal Pell Grant for federal financial aid and invest that when someone's 5 years old versus giving them a Pell Grant when they're 18.
Mm-hmm.
That's right.
Think about the return
That's
for
right.
that.
So that's exactly what he was basically saying. And he was the one who threw out that idea.
Do you have that white paper?
I can send it to you. Yeah, I can send it to you.
Us as well, please.
Yeah.
So it is something that, again, is being looked at all levels, at the federal level, the state level, the local level. But the amazing thing is that they want to use the power of the American capital markets and, the strength of the asset management industry in the US and the states who know their constituents the best to manage it at the state level, right, within 529 structures. So that's one of the most important
I think
things.
there's a huge opportunity for like a redesign of foundation thinking on what they do, like El Dorado Promise, the Murphy money that every kid that graduates El Dorado High School with certain parameters has a higher education to pay for in the state, right? So rethinking that, I mean, there's probably some pretty big investors that might be interested. That's very, very curious.
We're excited. Okay, and then the last thing is just to discuss our next meeting in June. The treasurer has asked if we could possibly move these meetings to 9 a.m.
Yes.
instead of 10, if that would be,
That
okay.
was a quick yes.
Okay.
For me, I mean, I don't know about.
Well, and that will enable us to then have our 529 and ABLE meetings back to back. Because right now we have, and for Kim, who travels in. So with that in mind, the 9 o'clock hour in mind, looking ahead at, and we'll formally, check everybody's schedules. We get a little bit closer, but we're looking at the week of June 16th or the week of June 23rd. And I know that's vacation time. But if there are, I know you are traveling out of the country with your family.
I am from the 18th to the 26th.
Can we do that June meeting on a pontoon boat?
Never mind.
Is that an option?
You bring the cooler.
It's all of us when we go in. House of a friend.
Can we make that one at 4 in the afternoon?
So I guess Monday or Tuesday that week would get for you, right? Well, you probably
I
can't do either.
I
You
might
attend
be
virtually.
more similar to Amanda and
Yeah.
be
Okay.
phoning in.
Yeah, I'll be out of town that week at the 16th, but Rod can make it if I can, so. Tuesdays work better, but whatever.
Okay.
Do we want to tentatively look at Tuesday, June 17th?
That'll work.
We could also probably hold that next Tuesday if we wanted to.
Okay.
Session will be over, hopefully.
Speaking of cooler.
You and- Thank you.
Okay,
All right, thank you.
you're done.
Thank you. All right, if there's nothing else, anybody want to adjourn?
So moved. Second.
Thank you all.
Thank you.
Thank you, Amanda.
Bye all. Thank you.
Bye.
Take care.